Capital rationing. Capital rationing, the concept is it occurs when a constraint or budget ceiling is placed on the total size of capital expenditures during a particular period. It means whenever you have some limited budget, you have few, you can say dollars, or you have few resources, your cash is limited, or overall your budget is tight, you have some constraint. So there are, but you have different options for investment. Which option you will choose with having limited budget? And that is during a particular period. If you have less budget, so then you have to apply this concept of capital rationing. Like we can do one example to understand this concept. As you can see on the slide, Julie Miller must determine what investment opportunities to undertake for Basket Wonders. Basket Wonders is a company, BW, and she has a limited budget of 32,500. The total limit, or you can say the total cash or total capacity she has to for this investment is $32,500. The total investment she has, maximum she can invest is $32,500. Okay, so now we will see where she can invest to get the maximum return. If you see on the screen, these are different projects available for investment for this company. These are 8 different projects. A, B, C, D, E, F, total number 8 projects. And ICO means initial cash outflow, initial cash outlay. The initial investment required for, like, let's suppose for project E, the initial investment required is 12,500, the initial cash out. And the IRR of project E, internal rate of return of project E is 26%. Like if she invests in project E will give her 26% IRR. And the net present value of project E is $500. And the profitability index of project E is 1.04. IRR, NPV, and profitability index are the 3 different capital budgeting techniques that we have covered in the previous lecture. There are 4 main capital budgeting techniques. One is payback period, IRR, NPV, and PI, profitability index. Now we need to make an investment. But our limit or our constraint is we have $32,500. So you can see in project A investment requirement is 500, project B 5,000. Let's suppose project H is 25,000. If she invests in 25 in project H, 25,000 investment is gone. The remaining balance will be 32,500 minus 25,000, that is 7,500. Like project H or project D, these 2 projects will consume all of her investment of 32,500. Total investment she can make is 32,500. And ICO is initial cash outlay or initial investment. The project D or project H will consume all of her investment, that is 32,500. So she will be left nothing for making investment in any other project. This is just a case. Now we will see which project will give her maximum return. If we decide on the basis of IRR, which project is giving maximum IRR? Here we can see it is project C. Project C is giving maximum IRR of 37%. 5,000 is for project C. Second, we can see there is project F. Project F is giving 28% IRR. Project C 37% return. Project F 28% IRR. 5,000 for project C, 15,000 for project F. The total 20,000 is invested. 5,000 plus 15,000. 20,000 is invested. We have maximum 32,500. Now we can see after 28, here we have project E. Project E is having IRR of 26%. This is the third highest IRR. The project C, project F, and then project E, 12,500. So if we add 5,000 plus 15,000 plus 12,500, it is 32,500, the maximum ceiling we have. So our overall investment is covered 32,500 by investing in 3 different projects, that is C, F, and E. Okay, now we will see what is we get if we make investment in these 3 projects. Now you can see on the screen project C, project F, and project E. 32,500 total investment. IRR maximum 37%, 28, 26. But if we also take IRR, NPV of these 3 projects, net present value from the same question, you can see project C 5,500, project F 21,000, project E 500. This is NPV, net present value. So if we add these 3 NPVs of C, F, and E projects, this will be $27,000. It means by investing in these 3 projects, C, F, and E, the company's wealth will increase by $27,000 because they have the largest IRRs. The total cumulative NPV gain or increase is $27,000. So this analysis is done on the basis of IRR. We have chosen those 3 projects which have maximum or largest IRRs. This is for IRR. So keep in mind, remember this $27,000 if we use IRR as an analysis tool. Next, we will go for NPV. Now, please select the projects which are having maximum NPVs, but the total budget or limit for investment is $32,500. Highest NPV we have for project F, that is $21,000, and this requires $15,000 as an investment. Second highest NPV is 7,500. That is project G. Project F having maximum NPV 21,000. Second highest is project G, $7,500. And the total ICU, total investment for these 2 projects will be 32,500. 15,000 for project F plus 17,500 for project G. So this is 32,500, the total investment we have for investment for these projects. So if we choose projects on the basis of NPV, we will choose project F and project G for our investment, and it will give us 28,500 total increase shareholder wealth. The total increase is 28,500. If we choose NPV as an analysis tool, if we apply NPV to select the projects for investment, we will choose project F and project G for investment if we decide on the basis of NPV, net present value. So this will increase wealth to 28,500. Previously, IRR has given us the answer of $27,000. Okay, the increase in wealth would be $27,000. But if we choose NPV as a tool, it will give us the answer of 28,500. 28,500 is larger or is better than $27,000 as a gain. Okay, now IRR is done and NPV is done. Now we will decide on the basis of PI, that is profitability index. Now you can see the same screen and decide which projects are having maximum PI, maximum profitability index. So if we see on the slide, we can see project F is having maximum profitability index, that is 2.40. So if one is project F, that is 2.40. Second is project B, that is giving 2.30. Total investment is 20,000 now. After that, we have project C, that is 2.10. Total investment now is 25,000, 15 plus 5 plus 5, F, B, and C, total 25. And now the fourth highest profitability index, PI, is 1.67, that is project D. The 25,000 plus 7,500 total investment is 32,500. So we covered all the investment. So if we decide on the basis of PI, this is project F, B, C, and D. You can see on the screen. F, B, C, and D. The investment for project F, 15,000. For project B, 5,000. For project C, again 5,000. For project D, 7,500. The total investment is 32,500 for these four projects, and they are having maximum profitability index 2.4, 2.3, 2.1, and 1.67. Now, if we add NPV of these four projects, F, B, C, and D, this is $38,000. You please focus here that the increase in wealth, increase in shareholder wealth here is $38,000. This is higher than $28,500 and $27,000. So it means, or we can conclude that if we choose profitability index as a tool for analysis of different projects when we have a limited budget, when we have constraints, like in the case of capital rationing, so the tool of profitability index will give those projects which are having maximum NPVs, like the answer would be greater. So here we can see the increase in wealth is $38,500, and this is far better than 27,000 and 28,500. So we have different three techniques, IRR, NPV, and PI. But the PI technique, in the case of capital rationing, when we have a limited budget, will give the maximum gain. So please keep in mind, the PI, profitability index tool, will give the maximum gain if we have limited budget for investment. Now you can see the comparison on the screen. We have different methods, PI, NPV, and IRR. The maximum value added is by the method of PI. So if you have some question like this, so you should apply the method of PI. PI generates the greatest increase in shareholder wealth. It creates greatest increase when a limited budget is there, when a limited capital budget exists for a single period. The condition here is when you have limited budget, then we should choose on the basis of PI. This is the topic of capital rationing. And this is the last topic of this chapter of capital budgeting techniques from the book of Fundamentals of Financial Management, that is by Van Horn.